Every year, millions of people get their tax return back, look at the bottom line, and decide whether it was a good year or a bad year based on that number. Maybe you owed money, maybe you got a refund. Either way, you closed the tab on another year and moved on. But here's the thing, that return, the document you signed, tells almost nothing about whether you're actually managing your tax situation well. It tells you what happened. It doesn't tell you what could have happened differently. I'm Bill Bourbonnais, and welcome to Three Things Thursday. Today, we'll reveal three things your tax return doesn't tell you. Thing number one, what you owed, not what you could have saved. Your tax return is a compliance document. It's backward-looking by design. It reports income, deductions, and tax liability for a year that's already closed. The IRS isn't asking you what you plan to do, only what you actually did. The planning window for most of the numbers on your return closed on December 31st. By the time your return is prepared, the decisions that built your tax bill or didn't were made months ago. The entity elections, the timing of income and deductions, the retirement contributions, cost segregation study, the accountable plan that nobody set up, all of it is already baked in. The chapter is written. If you're looking at your return in April and seeing a number you don't like, you're reading a history book. The question isn't what happened, it's whether you're starting the next chapter differently or waiting until next April to be surprised again. So again, the return tells you what you owed. It says nothing about what could have happened if the planning had happened earlier. Thing number two, your return doesn't show you the gap. This is one thing that most people never see because it's not on any form. Your tax return shows taxable income, revenue minus deductions you actually took. It's a different number from what taxable income could have been if you'd taken every election, every deduction, and every strategy you were eligible for. The return doesn't show you the deductions you qualified for but didn't claim. It doesn't show the entity structure that would have produced a lower tax bill. It doesn't show you the timing decision that moved a chunk of income into a cheaper tax year, or the retirement contribution that would have pushed your AGI below a certain threshold that cost you somewhere else. The gap between what you paid and what a well-planned version of what you would have paid, that number doesn't appear anywhere on the return. It's invisible. And because it's invisible, most people don't know it exists. For some people, that gap is a few $100s. For business owners and real estate investors, it can run into tens of thousands of dollars a year, compounding quietly for years. So again, the return shows the deductions you took. It doesn't show the ones you left on the table. The gap is the planning opportunity that never appears on any line. Thing number three, your return is not a strategy. Two things most people have wrong about their tax return. First, a refund is not a win. If you're getting a large refund every year, you over-withheld. You gave the federal government an interest-free loan for 12 months. The IRS held your money, paid you nothing for it, and sent it back in the spring. That's not a good outcome. That's poor cash flow management dressed up as a tax windfall. Secondly, owing a balance at filing isn't necessarily a failure. If you're making quarterly estimated payments calibrated to your actual tax liability, you may owe a small balance at filing, and that's by design. You kept your money working in your business or your portfolio longer. The number on the bottom line of your return doesn't tell you whether you're ahead or behind. It doesn't tell you whether your advisor is doing a good job. It doesn't tell whether your tax situation is well managed or poorly managed. Only a forward-looking plan gives you that picture. Your tax return is the scoreboard after the game. Strategy happens during the game. So in closing, here are three things to remember. Your return tells you what you owed. It doesn't show what you could have saved. It doesn't show the gap between what you paid and what good planning would have produced. And a refund isn't a win, it's a data point. The planning conversation is the one that happens in June, September, and December, not the one that happens after the deadline. Now, if distinctions like this are helpful, Three Things Thursday drops every week. Hit subscribe or follow so you don't miss the next one. And if any of this connects with your situation, that's a conversation worth having. Find us at bourbonnaisetax.com. I'm Bill Bourbonnais. Thanks for joining us for Three Things Thursday. We'll see you again next week. Have a great day.